It's interesting, I've heard a lot of people express interest in bank loans in the last couple of months. It's not getting priced unfavorably yet.
Right, not yet, in fact. And in fact, when you compare right now, in this current moment, bank loans and high-yield corporate bonds, or similarly rated corporate bonds to the bank loans actually have a little bit of a premium still in them. And I think that people are looking at the overall spread environment, the pricing difference between these products like bank loans and corporate credit and treasuries, and saying, oh dear, the spread is getting very narrow. But we think it's a combination of two things. One is we think treasuries are still possibly a little bit too high. The risk is to the downside for rates there. And we think that we could move beyond averages and toward the historical lows in an improving economic climate.
If we are seeing interest rates perhaps lower than where they are now, does that give the stock market even more room to climb higher?
Yes, absolutely. The stock market price-earnings ratios are actually quite dependent on where interest rates sit. And we've done some analysis with some interesting charts showing that where we are about 17 times price-earnings now on the S&P 500, you could expand to 24 times PE of 24 and still be within sort of one standard deviation within a historical range at this low 0 to 2% interest. As interest rates go up, PE multiples start to compress. And we see a pretty benign interest rate environment going forward for a lot of reasons.
So a long-only strategy on the equity side, or do you perhaps have a little bit more risk in your way of managing equities this year, and you're not just going long-only?
Sure. I think, interestingly, we've looked at equity markets. There are a lot of dynamics going on at the sort of macro market level in equities right now, and that's where we look instead of so much at the individual stocks in my team at Guggenheim. And our CIO and I have worked together to come up with a model looking at where volatility is going. And we see actually volatility increasing over the next few years. It was historically unbelievably low last year. The return for every unit of volatility was really almost at a historic high, and that can't continue. So we see strategies where you try to minimize your volatility either actively or passively as something important to do in this market.
Such as through options?
Sure, options or a covered call strategy, for example, is another way, and we have a couple of our portfolio managers pursuing those strategies.